What's going on, YouTube Nation? This is GB Merce. A lot of people invest in exchange-traded funds. I'm going to show you some tricks and tips that help me decide on whether I should buy an exchange-traded fund or get rid of an exchange-traded fund and throw it in something else. But the first thing is really understanding what a ETF is and how you can generate passive income with ETFs. So ETF is basically a combination of a bunch of stocks or a fund. Like an example I can give is like if there's a one that follows a NASDAQ fund or one that follows a bond fund or a specific fund with bonds that are like aggregate bonds or corporate bonds or that are exchange traded funds. They're all a bunch of bonds or a bunch of stocks together. So I'm going to just refer to nerdwallet.com with their definition of an ETF. It's explained very well and very easily. An exchange traded fund is a basket of securities, stocks, bonds, commodities, or some combination of these that you can buy and sell through a broker. ETFs offer the best attributes of two popular assets. They have the diversification benefits of mutual funds while mimicking the ease with stocks that are traded. Like any financial product, ETFs aren't one-size-fits-all solution. Evaluate them on your own merits, including management costs and commission fees, how you easily can buy or sell them, and their investment quality. So there are pros and cons with ETFs, okay? Sometimes they're a combination of stocks. Let's just say like a rate ETF, like Vanguard VNQ is an example. It's a combination of a bunch of rates all in one. So let's just say if one rate's taking a big hit, your dividend isn't really going to get hit that bad, and the price per share is not going to get that bad. But for an example, VNQ, I think it's right around $80 or so, maybe almost reaching 90. It gives off a quarterly dividend, and if you watch my previous videos on realty income, it gives off a pretty nice dividend. And individual stocks or individual rates sometimes give off a better dividend than ETFs in the long run. So if the stock's beating the S&P and the ETF's beating the S&P, the ETF's a little bit safer. So I threw some money in some ETFs. I have a few M1 finance accounts in ETFs. I have on my M1 finance account, I have the Vanguard BND, which is the Vanguard Bond ETF. I have one that follows, I have SPHD. I know I sold it, but I have it on my M1 finance account where I throw like $40 a month in, like a small monthly dividend portfolio. ETFs are safe. They are going to grow over time. They help generate passive income for you. They are going to probably grow, so that's a nice thing. So, there are management costs and commission fees. A lot of these companies, Invesco, Vanguard, Wisdom Tree, they really have a slow commission fee, and it's not really going to hurt you in the long run. I know in my Fundrise account, I know it's a private rate, but you have to do certain fees. It doesn't come out of my bank account; it comes out of my dividend mostly. So I don't really see that, but it's just some things that you got to look out for. I wouldn't really worry about the the management costs and commission fees unless it's taken out of your own bank account. It's usually, and I'm pretty sure, you can correct me if I'm wrong, but if you put money in that, a certain percentage comes out. I know I had to pay like, I don't know, out of my dividend, like $7 or something for Fundrise. And Fundrise really likes to compare themselves to the Vanguard VNQ, which is a exchange traded funds with some of the best rates in the world. So instead of just having all this money in just one rate, like, you can have a well-diversified portfolio in your exchange-traded fund like Vanguard VNQ with multiple rates that are doing very well. So you have all these combination of all these really good rates into one exchange traded fund. So, like another example that I have, and you'll see later in the video, is the SPLV, which is like a it's a low volatility stock that follows the S&P and is right in line with the S&P. So I'm going to give you my ETF strategy. I call it the trifecta. If you get all three of these in a row, you kind of I joke around, let's call it the unicorn. It's like perfect. I mean, a unicorn's like impossible, but it is possible if you can get all three of these in a row and get the trifecta. First is the S&P. Is there growth versus the S&P? Is it in line with the S&P? Is it is it a little bit below the S&P? Is it doing really well? Is it raising its dividend? Okay, it's got to increase its dividend if you really want that for passive income. Okay, you don't want something that's stagnant, that's just going to sit there and just really do some stuff. And three, what does Morningstar say? So number three, I really look at that. I'd say about 80 to 90% of what Morningstar says to dictate my decision. If you have an exchange traded fund or you're interested in one, not bonds. Okay, bonds are usually going to be 3, maybe 4-star at best. I'm sure there's some 5-star ones right now, but I'm 34, so I really am not. I mean, I have one M1 finance portfolio where I put like $20 a month in like a bond fund, but I'm really focused more on exchange traded funds that follow the stock market, that follow the S&P. And Morningstar is really going to dictate my decisions. So I'm going to give you an example of the ETF versus the S&P. I have on my M1 Finance account Noble Stock. Okay, that's ProShare Dividend Aristocrats, the 500 S&P. Its competition is fierce with the S&P. It is right in line with it. It's very well managed. The fee isn't too bad. I have that. I think I'd have to look at my phone, but I'm pretty sure I have like 5 or 6 or so. So I'm throwing $40 a month, right around that, with some of these stocks. Like you do a down payment, and the dividends are going to reinvest over time, and the money you're going to put in, it's just going to reinvest. That's growing like crazy. So if I were you, I'd put some money in it. If you have an opportunity, it's not cheap, but you're going to get some money off of that. So here's the thing with the S&P, competition is fierce. Every manager that runs an exchange traded fund, it's going to drive them nuts when you tell them it's not in line with the S&P, because they try to beat the S&P. They try to find things that compete with the S&P, and it's a very big dictation. It dictates a lot of people's decisions if they want to buy an exchange traded fund. So think of it kind of like a mutual fund, but it's a stock. And you want to compete with the S&P. Like I said in this one, everyone wants to beat the S&P. It's like Alabama in college football or the New York Yankees in Major League Baseball. Everyone wants to beat them. Everyone wants to be better than them. Everyone wants to brag that they're better than the S&P. The managers want to beat the S&P. I can tell you some people I've met before that manage like ETFs and their brokers. This keeps them up at night a little bit, maybe an extra hour or two, to try to find strategies to beat the S&P, to get their clients very happy. So this is not just local people, this is managers across the world that try to manage these ETFs and beat them. I can almost guarantee people will call and ask, how does it compare to the S&P? Another thing is, you can even invest in the S&P. It's pretty expensive. It's how much is it? $2,966 right now, as of October 14th. So that's pretty expensive. Sure, it gives off a little bit, but look at this, $71.05 compared to $2,966. This is right in line with the S&P. I'm sure Noble will beat it. And I mean, it's right in line. You see it in the blue right there. So this is just an example of how some dividend stocks compete with the S&P. And here's the dividend trend of SPLV. So like I said, it needs to go up. So as you can tell, it's starting to trend up. Maybe a little hit here, but it's going up, it's going up, it's going up. So, there's a perfect example of how the dividend increases. I just use NASDAQ as a reference. So it's going up. When you buy stocks and you want dividends, it goes up. So that's your goal. So again, this is a low volatility exchange traded fund. Some of the stocks that you invest in, I'm sure it gives off a better dividend, but here's some things looking into it that helps with your portfolio. So I really like SPLV. Again, I sold some shares with SPHD, but I just added that to my M1 Finance account. So, this is something that you need to evaluate. And here's the other thing. With Morningstar Ratings, okay, this really dictates my decision. If you look at the stock QYLD that I invested in earlier, it's not really growing as much. It's not really growing against the S&P, but it's 5-star rated by Morningstar. So when Morningstar tells me it's 4 or 5-star, I'm going to invest in it. They actually gave a 5-star rating last time I checked on AGGY, which is a bond that follows, it's an aggregate fund that follows Barclays, and it gives off a monthly dividend, and it's actually 5-star rated. And I'm actually interested in putting money in that, just even though it's a bond fund, but still Morningstar says it's 5-star rated. It's one of the best ones by WisdomTree, and I really like what I see. WisdomTree is a very good company that gives off, it has a lot of exchange traded funds that are good out there. So that's one thing that you want to consider. So just remember, 4 or 5-star only. So here's your goals, okay? Morningstar, beating the S&P, increasing dividends, the trifecta, as I like to joke around, the unicorn. Aim for the trifecta. Buy these ETFs when they are low and a hot stock out there, okay? So I know I put money in an M1 Finance account with SPLV, and it's like, Noble, when it's like $70 a share, but what if I put money in when it was like 30 or 40? I mean, look at how much I'd be racking up in cash. So that's one thing that kind of 34 and as an investor I'm starting to learn, and I'm getting better, way better at, is getting these when they're low. I always say have about $2,000 saved up ready if the stock market takes a hit, and you can put some money in some dividend stocks or exchange traded funds. And again, the higher the price, the more expensive they are. So as I referred to in my previous bullet point, you got to get them when they're low. If you follow this strategy and reinvest for years, you'll increase your passive income. Again, my goal and the way and the reason I made this channel was to let you guys know that you can treat dividend stocks as pretty much a retirement pension. And that's kind of what I'm treating it as. I'm getting no money in the bank, barely anything. And, if you put yourself in a money market fund, you don't only get like next to nothing out. So, and, you put money in an ETF or a rate or some of these high dividend ETF stocks, you're going to get some nice passive income. I mean, my long-term goal is to make $1,000 to $3,000 on dividend stocks a year, which is pretty nice. Again, that's going to be a nice retirement pension. This passive income you can pay for utilities. I have enough to probably, my dividend stocks pay for utilities right now if I wanted to, but really it's not worth it. I can afford that, and I would much rather reinvest my dividends so I can get to $1,000. Remember, the ETFs try to beat the S&P. Some ETFs are bond funds, so just look at the 4 and 5-star rated. Right at 34, I'm really not focused on bonds as much compared to stocks. I'm probably going to throw money in stocks and just let them reinvest for a long time. Sure, the market could take a hit, but I know there was an article recently, I'll have to post that on this video, but they were discussing like how the 60-40 stocks, 60% stocks, 40% bonds is not the way to go now. If you put money in stocks and dividend stocks, your goal is to have your money make money and have the dividends reinvest and for the price per share to go up. So again, invest in an early age with monthly and quarterly dividend ETFs. They're going to grow. Again, the higher the price, the more expensive they are. So Thank you for watching this video. I appreciate you guys being involved in my channel. Make sure you like, comment, and subscribe, and let me know what you think of this video. Do you invest in ETFs, or do you just prefer stocks? Do you like your bonds, or what's going on? So again, make sure you like, comment, subscribe, and hit that bell so that more videos, so you can watch more videos and don't miss out on more videos.